warahmatullahi wabarakatuh. My name is Rahmediana Murti with NIM 2020-2020-010218. Today I want to explain about tax planning. The definition of tax planning is defined as the process of organizing the business of taxpayers or groups of taxpayers in such a way that their tax debts, both income taxes and other taxes, are in minimal position, as long as this is allowed by the provisions of the applicable laws and regulations. The purposes and benefits is the purpose of tax planning is more specifically aimed at fulfilling the following. The first, eliminate or remove taxes altogether. The second, eliminate or abolish taxes in the current year. The third, deferring revenue recognition. The fourth, changing written income in the form of capital gains. The fifth, expanding the business by forming a new business entity. The sixth, avoiding double taxation. And the seventh, avoiding forms of income that are routine or regular or established, multiply or accelerate tax education. The benefit of tax planning is the first, savings in cash out, because the tax, which is an element of the cost, can be reduced. Second, regulate cash flow, because with careful tax planning it is possible to estimate cash needs for taxes and determine the time of payment so that companies can prepare cash budget more accurately. Next, law regulations and provisions. There are two from national tax planning and international tax planning. The national tax planning is a tax plan that only has business activities in Indonesia and only conducts transactions within the country. The rules that need to be considered in national tax planning include the first, Law Number 28 of 2007 concerning KUP and its implementing regulations. The second, Law Number 36 of 2008 concerning income tax and its implementing regulation. Third, Law Number 42 of 2009 concerning PPN and PPNBM and their implementing regulations. The international tax planning is carried out for business entities whose business does not only cover the domestic area but also abroad. The tax planning is regulated in the following. The first, Law Number 28 of 2007 concerning the KUP and its implementing regulations. The second, Law Number 36 of 2008 concerning income tax and its implementing regulations. Third, Law Number 42 of 2009 concerning PPN and PPNBM and their implementing regulations. Fourth, Tax Treaty or P3B or Double Tax Avoidance Agreement. Next is strategy and tax planning. There are several ways that are usually done or practiced by taxpayers for taxes to be paid. For example, as stated by Sopar Lumbar-Toruan in his book Tax Accounting, 1996, namely, the first, tax shifting, is the transfer of the tax burden from the tax subject to another party. Thus, the person or entity subject to the next may not bear it. Second, capitalization is a reduction in the price of the tax object equal to the amount of tax that will be paid later by the buyer. Third, transformation is a way of tax evasion carried out by the manufacturer by bearing the tax burden imposed him. The fourth, tax evasion is tax avoidance by violating the provisions of tax regulations. And the last is tax avoidance by complying with existing regulation. Other approaches to tax planning is there are two other approaches that can be taken as a strategy in an effort to reduce profits, which ultimately also reduces tax to be paid. Namely, the first by reducing revenue, the second by increasing costs or expenses. The first method is by reducing revenue, generally quite risky because this is usually done by falsifying documents, or posting fictitious amounts where the recording of transactions is done incorrectly. The second way is by increasing cost or expenses. This is also has a risk, and the method or path taken is also the same as the first alternative, except that the tax regulations provide burdens that can be deducted from gross income to determine the amount of tax that must be paid. It should be noted that the payment of the tax amount that is less than it should be cannot only be done with tax planning but can also be due to the negligence of the taxpayer himself. For example, in terms of first, ignorance. It is mandatory not to be aware of or not to know the provisions of the tax laws and regulations. The second, error. It is that the taxpayers understand the provisions of the tax laws and regulations, but it's wrong in calculating data. The third, misunderstanding. Is the taxpayer wrong provisions of tax laws and regulation? The fourth, negligence. It is the taxpayer negligence to keep the book along with complete evidence. Taxpayers are sometimes less aware of their duties and obligations as good citizens. Most of the people will never absorb their obligation to pay taxes in such a way so that they fulfill it without grumbling. Even if there is the slightest possibility, they are generally inclined to escape every tax. This matter has been and it's only one happening now but for a long time, and not only in some countries but in everyone, both individually or in a group. In many countries, there is a tendency to fight against the taxes. Instructions for doing tax planning. The first, strive to have a stable income to avoid taxation from income classes with high rates or top rate brackets. Second, spreading income into the income of several taxpayers, such as the formation of corporate groups. Third, transform ordinary income into long-term capital gains. Fourth, take full advantage of the provisions regarding exclusions and discounts. The fifth, using the money from the tax exemptions for the purpose of expanding the company that gets conveniences. Six, establish a company in one line of business in such a way that the overall use of tax rates, earning potentials, losses, and rate of assets can be regulated. Seventh, accelerate or delay some income and expenses to take advantage of possible changes in high or low tax rates, such as the VAT or government borne VAT, and so on. 8. Spread the income into several years of income to prevent the income from belonging to a class of income that has high rates and delays paying taxes, such as installment sales, credit, and so on. The last is conclusion. The conclusion is many people are reluctant to pay taxes. This reluctance could be due to the absence of a direct performance counter given as a result of the payment. It could also be because the tax is considered a burden by them so that they are afford to reduce it. For large companies, setting the tax amount to a minimum will be very beneficial because there is a cash flow that can later be used and utilized for the benefits of other companies in terms of expenses that are directly related to the company's main activities. If you want to regulate the amount of tax that must be paid so that it is minimal, it is an in-depth knowledge of the tax regulations themselves. Because this is done by taking advantage of loopholes or things that have not been regulated in the law, there are several strategies that can be done in recognizing the amount of tax that must be paid, namely shifting, capitalization, transformation, evasions or avoidance, and smuggling. All of the above strategies are part of tax planning. Tax planning provides a general formula that can be used to systematically regulate the amount of tax that must be paid. Thank you, everyone. I apologize for all the mistakes and shortcomings there, and thank you very much for all your attention. Assalamualaikum warahmatullahi wabarakatuh.